All right, live. How you doing, friends? This is Coach Ernie here, and this is the zero DTE, zero DTE morning analysis. It is Monday, November 18th, a little bit past 8 o'clock. Getting a little bit of a late start this morning. Had a busy weekend. I was in Nashville this weekend for a wedding. It was very nice. A lot warmer there than it is here in the Boston area. However, let's get to it. We're here to figure out which way the market's going, the volatility, so that we can figure out our exposure to that risk, and where are our entry opportunities. We specialize in putting on asymmetric trades, typically an out-of-the-money butterfly every morning when the volatility is highest, looking for a volatility crush event sometime during the day. We play directionally. Our asymmetry helps us achieve two particular goals that we're after, and that is a minimization, or try to minimize the volatility of our returns, our drawdown, while at the same time trying to maximize the return on capital that we put to work. And so every morning we do this exercise, this pre-morning or pre-market analysis, so that we can set up our trades, understand exactly the market situation, and so we do that every morning. So let's get started. All right, we want to get to Trading View. There we go. All right, volatility is a little elevated this morning, so that's a little bit of a surprise. I haven't seen anything over the news wires or anything like that. There are no specific economic reports that are out there, but of course I was in Nashville listening to music all week, so what do I know? I just go by the numbers. It's a little bit elevated, but still we're in what we would call zombie land, or right on the edge of zombie land in Goldilocks. What I do here is I split up the VIX into three primary volatility regimes. It's our way of just understanding where we are, and a communicative way of talking with the group. And through empirical studies, I have discovered what are the optimal widths or range of widths of these butterflies, these out-of-the-money butterflies, to put on that will give us the proper risk exposure, proper pricing, etc. So when we're in this range, we're between 10 and 20. I would say today probably closer to 15 to 25. Notice I always say a range because I'm not really sure exactly what end of that range is. What I then do is refer to another measure where I'm looking at the way the market is pricing options this morning. And the easiest way for me to do that is to put on a standard trade that I always look at, and that is an at-the-money butterfly on the E-mini S&P futures, 50 wide. I look at the price of that, and then through this scale that you see at the top here, I determine what part of that range that I should be on. Currently, that reading is, well, we can take a look at it here. You can see it's a little bit above 25, 26 and a quarter. Based on my range chart, that's somewhere in the middle here, in the middle of my ranges. So if I'm 15, 20, 25, then I'm going to pick something like a 20 wide fly. That gives me the proper risk exposure for a market like today. That's not counting what could possibly happen today, but I have to start somewhere. All right, so we know that. We also want to determine our direction, and that shouldn't have changed very much since last week. So let's take a look at the SPX, and the way I do this is pretty simple. Look at the moving average on a daily chart. Here I'm showing the Hull moving average on TradingView, and my methodology, it's a 21 period. You can pick anywhere from 14, 21, 28, something like that. That would give you a good feel for what constitutes a trend. And the way I look at it is, if it's above the moving average, then I'm taking a bullish stance or putting an out of the money call fly. If it is below it, then I'm taking a bearish stance and putting on an out of the money put fly. So you can see clearly that we're below, and if we look at the current market, that hasn't changed much. In fact, the futures are almost exactly where the Friday close was currently. So there you go. We know our direction. It's going to be a put fly. We know the size of that fly and what kind. It's going to be a 20 wide put fly. And the next thing that we need to figure out is where our entry opportunities are going to be. So because it's a put fly, you know that no market goes in a straight line, typically goes with pullbacks or pull-ups in the case of a downtrending market. So we're looking for those pull-ups so that we can determine what's the best time or the best entry event. And the way we do that is we look at market structure. By doing a structural analysis on the volume profile, it leaves a clear roadmap where support and resistance would lie. And that's typically on the inflection points or the edges of profiles. And so I'm going to go over that tomorrow in a little bit more detail, how we actually construct the volume profile. Let's say that I've already done that. And we take a look at what you're seeing here is that markup of the structural analysis. And right here, these vertical lines are just basically masking off the morning session, because that's typically where we'll take a trade. And so right now, this is this morning. Let me just expand it a little bit. I would be looking for at the open something like this to happen, maybe a pull up into one of these areas and then a continuation down into any of those structural elements. So what I will often do is just take a little square like this, a little rectangle, and put it over there so it's a little bit easier to see. And so when I enter that region, that's when I'll take that trade. All right. So the most obvious candidates this morning are at 59.13 and looks like 59.36 this morning. So if it hits any of these areas within that time frame, I'm looking for some sort of evidence using perhaps a candle technique or a price action technique to see whether or not it indeed is looking at that as resistance and candidate for a turnaround, and I'll take a trade there. That will be my entry event. So we'll report on that a little bit later. It looks like we're under a little bit of pressure this morning and we're going down a bit. So there's a possibility that we could also have an event down here. All right. So tomorrow, like I said, I'll do a treatise on the volume profile and market structure and how we anticipate these. Now, why am I taking it in the morning session? Because in the morning, typically that is when you have the most volatility in the day, and then it tends to drop off. The theory here is that if I put on a trade in the morning, I'm getting the best price action I can. It's appropriately sized. I'm waiting for a move towards my fly, and so that's essentially the setup. If we do get an event that and a move towards our fly, and we get near the profit tent later on in that day, I would like to see a rapid increase in the value of that fly, and that's typically what happens after volatility falls off as we go into the afternoon session. So those are kind of the dynamics that we're looking for. Doesn't always end up that way. It's a probabilistic trade. If it goes against us, with the asymmetric position that we're putting on. In other words, we're putting on a position that is typically 1 to 9, or for every dollar that we risk, we're looking to make as much as $9. That will put us into a good position even if it goes against us. We tend not to manage those positions. We size our trades in such a way that there's no need to manage it. So there you go. Let's go back to the big head. All right. So we have everything all set. We know our direction. We're bearish. We know our width. We're around 20 wide. We know our entry targets. And now it's all a matter of waiting and seeing. So thank you very much. We'll see you tomorrow with that volume profile analysis. Take care.